This section takes a look at operating, investing, and financing cash flows. You know that the cash flow statement has three categories: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Operating activities create revenue, expenses, gains, and losses. Investing activities relate to long-term assets, typically buying and selling long-term assets. Financing activities relate to long-term liabilities and owner's equity. Long-term liabilities such as notes payable, bonds payable, all those belong in your financing activities section. Owner's equity items also belong in your financing activities section. So anything to do with stockholders such as issuing common stock, purchase of treasury stock, payment of dividends, all those go into their financing activities section in your cash flow statement. Going back to the operating activities section, you know that operating activities relate to creating revenues, expenses, gains, and losses. All these items are found in your income statement. But your balance sheet also has some items that relate to operating activities in your cash flow statement. Current assets and current liabilities affect your operating cash flows on your cash flow statement. As you know, the rest of this diagram, investing cash flows only relate to long-term assets, and financing cash flows relate to long-term liabilities and owner's equity. So you need to look at two places when you are preparing operating cash flows. You need to look at your income statement and you need to look at the balance sheet. And in the balance sheet, you need to look at your current assets and your current liabilities because those, again, affect your operating cash flows. There are two formats for the preparation of your cash flow statements. You've got your indirect method and your direct method. The indirect method reconciles from net income to cash provided by operating activities. The indirect method is the method that you've seen from Chapter 1 onwards. The direct method simply reports all cash receipts and cash payments from operating activities. Let's take a little bit more detailed look at these two methods. The indirect method and the direct method are only different in one section of the cash flow statement. They only differ in the cash flows from operating activities section. When you're starting off with the indirect method, the first item you put down is your net income. Then, as you learned in Chapter 7, you add back depreciation and then you make all the other adjustments that you need and you end up with your cash flows from operating activities. We're going to learn what these adjustments are in a minute, but let's take a look at what we do in the direct method. When we're using the direct method, all we report is cash receipts and cash payments from operating activities. The direct method will report things like cash collections from customers, it will report cash payments to vendors, it will report payments for salaries, and so on and so forth. And then you will end up with your cash flows from operating activities. The most important thing to remember is it does not matter which method you use, whether you use the indirect or the direct method, your cash flows from operating activities will end up being the same. What is different is the two methods, the methodology used to calculate those cash flows from operating activities. When you're using the indirect method, the descriptions are different compared to when you use the direct method, but you end up with the same cash flows from operating activities using both methods. The other thing that you need to remember is that financing activities and investing activities are the same. So there is no discrepancy between investing activities and financing activities between the indirect method and the direct method. Both methods only have one difference, which is cash flows from operating activities. The total cash flows from operating activities that you end up with is the same for both methods. It's just how you arrive at those two numbers are what's different.